Hi guys, welcome to a new episode of Let's Talk. I am with Dimitri, my co-host, and today we have a very special guest. It's Jakub Rochlitz. He's a corporate finance student from Prague, beautiful Prague. I visited Prague recently, very beautiful, from the Czech Republic. And today we're going to discuss something quite interesting, actually. Jakub's strategy, and we will really dive into it. It's to combine dividend and AI. So combining the two at first sounds like something almost mission impossible because both are so different. Usually, dividend paying assets tend to be more stable over time in terms of price. The returns are mostly dividend based, while AI has a more maybe something more speculative in its nature. It's not the actual use cases and actual growth cases. So it's not the word speculative in the negative sense of the term, but it's something perhaps more difficult to predict and to pick than dividend assets. So we will center our discussion around that. So thank you, Jakub, for joining the episode today. So maybe you want to introduce quickly your strategy and maybe how you started actually your investing journey and how you ended up marrying two opposite worlds, dividends and AI. So how did it start?
Sure. Thank you for the introduction and welcome everyone. As for how I got into investing, basically it was thanks to my father. He's been a long time businessman and he's become an investor in the past few years. And he really motivated me and inspired me. I originally studied computer science, but
Mm.
this was really such a life-changing thing for me that I decided that I want to study finance, I want to work in finance, I want to learn everything there is to know about investing. I started reading about Warren Buffett and the usual investing legends you get into once you start. And it really inspired me and motivated me. And I decided that this is the field that I want to become an expert in and that I want to work in and basically dedicate my life so far to. I joined eToro in about in 2022. I became a PI at the end of 2022, so it's been almost 2 years. So far, I have around 230 investors who copy my portfolio, and I managed to beat the S&P 500 all 3 of those years. And that's practically the goal of the portfolio, of course, to provide my investors with returns that they could not get by passive investing, to create alpha, of course.
Mhm, mhm.
As for the
That
portfolio, you mentioned dividends and AI. I think it's a mix of the 3 pillars of my portfolio construction. One is growth, then there's quality or value, because all companies are high quality, the ones which I own. So there's growth, there's value, and then there's dividends. These are the 3 parts that make up the portfolio. It's different companies. Usually I go for the least correlated companies, of course, to keep the risk low. And that way I can keep the portfolio growing while also earning above average dividend income for my investors and for myself, because I believe that it is the best way to earn passively and over the long term. That's why the portfolio is called a dividend fund. I wanted to create passive income for me and for my investors, in the sense that they no longer have to care about their investments or the portfolio. They just get money.
Mhm, mhm. That's quite interesting. It sounds a little bit like a dividend trickle down strategy. So if I can explain myself, you have that component of dividends, and it sounds like the passive income that you receive, that you reinvested in value and growth assets to at the same time enhance your returns.
Exactly. That's why I like dividend income, because it gives me the flexibility to earn from my high dividend payers, so less growing assets, and invest that income into assets with maybe more potential, more growth.
Mm.
And
Yeah.
especially
Well,
in times of market downturns, that's when the dividends really kick in, and that's when you want to use the dividend income, to dollar cost average on your other holdings.
A quick question, and then I will actually ask something to Dimitri, because I see Dimitri is somehow very thoughtful. What would you say is your allocation percentage? I mean, maybe you don't have the exact number, but between gross value dividend, is it 1/3, 1/3, 1/3, or is it half growth and value, the other half dividend?
Of course. It's not necessarily fixed. It's more what makes more sense, but I would say that I go for an equal split and then adjust that based on which types of companies I expect to perform better, right? So I can increase the dividend part of the portfolio if I think that, for instance, rates are going to go down and then real estate companies are going to appreciate in value, but I have also
Or
right now.
or if a recession is coming, for example, you would rather you would focus more on dividend payers, right?
Exactly.
Mm.
If economic conditions were to deteriorate, I would lower the growth part of the portfolio, reduce it, and then invest in more value stocks, more dividend stocks.
And
But
yeah,
right now, I think the growth is the majority of the portfolio in the current environment.
Dimitri, you're
Yeah.
puzzled, and I think I know why you're puzzled, because your strategy, your portfolio is really value and to some extent growth also, or you combine both growth and value, and dividends is something that you absolutely don't care about. This is something we had discussed in private, that dividends, you're absolutely fine if you had 0% dividend yield.
Yeah, it wouldn't make a difference to me if I had zero, even though I have 1%, 1.1% dividend. When I'm making a decision to open a new position in a stock or a company, the dividend is the last thing I'm thinking about. That doesn't make a difference. But thinking what Jakub just said, I'm trying to understand. We have guests, and I'm trying to understand their point of view, how they see investing, because it's well known. Each investor sees the world differently than the next investor. So I'm trying to make sense of the dividend and growth, the cloud and software growth along with dividends. And instead of buying the HPs and the Dells and the Intels, the boring tech that nobody likes, that is basically obsolete and is going to go away in some point. You went for the standard dividend-paying stocks, the real estates, that they're going to be there, whatever happens, they're going to be there. And then you have the new breed of companies, the software, the clouds, that they appreciate in price and basically provided all the returns in the last 15 years. I mean, if you were into Amazon, Microsoft, Nvidia, Apple, and basically you're like flat. You probably underperform the S&P. So it makes sense as an investor to invest in those, and then you balancing your risk with some dividend, instead of going the route of, okay, let me go into boring stuff. I'm going to get the dividend. I'm going to get the average. So if I'm getting this right, you went that route, correct?
Yes, I did, because just like you said, if I invested only in dividend stocks, or I picked tech stocks that pay dividends, which usually pay 1, 2, maybe 3% at best, I would own a stock that's not really growing, because if a tech stock is paying out dividends, it usually means that they don't have much growth, with some exceptions like Nvidia and such announcing dividends lately. And also, I would not get very attractive dividends from those companies. All the while, I see the tech business as much more risky than the real estate or the utilities business.
Yes.
So in a sense, I'm trying to combine really fast growers with really stable growers and dividend payers in the portfolio. So for instance, I think the core thing I look at is to protect the capital of me and my investors. The growth always comes second. Like Buffett said, the first rule of investing is don't lose money, right?
Yeah.
So I'm trying to do that and then focus on growth. So just like you said, I have the tech stocks, the innovators, the fast growers, which are on the bleeding edge of technology. They don't pay dividends because they have ways to reinvest the cash. I like that. At the same time, a large utility company, for example, like NextEra Energy, or a real estate company like Realty Income with over 15,000 properties, is maybe better off reinvesting or like giving back some of that cash in the form of dividends or share buybacks and returning that to investors, because those are mature businesses. They don't grow as fast, but they are much more resilient. So in that sense, I'm trying to combine really, I would say, high risk and really low risk assets to get a portfolio that in the whole has a good risk profile and a good growth profile.
That must be the challenge of you trying to balance the really exciting, the really sexy names that you get the news. You turn CNBC on and you see Nvidia, you see Amazon, you see Microsoft, you're not going to miss anything. And then you have some other names that they are now well known, they're not favored by investors. So you try to balance the act, you try to do both. And I just want to know if you have any, what the challenge is, because I can tell my own story that sometimes you have to look the game one way when Nvidia is reporting and is having a 5% beat and the stock goes down in the aftermarket, and then if Verizon just goes right on the estimates, then the stock goes up 3%. So you have to make sense of the different dynamics of different sectors within the economy. So how do you go about this?
How do you go about this? And I think the next, actually, my question was also related, is how do you pick actually those assets? When do you decide that, you know, that company makes sense to have in my portfolio, but not that one, you know?
I understand. Okay, so for the first question, I would say the biggest challenge is, of course, deciding what weight do I want to have in each company. Because like you said, I'm combining companies that grow a lot with companies that don't grow much at all. And it would be very easy to underperform the market, right? Because dividend payers usually don't outperform the S&P 500, while tech companies do, but they have large swings. If I held just tech stocks in 2022, I would have minus 30, 40%. But at the same time, if I held only dividend payers in 2023, I would have 15 instead of 25 of profit. So I would say the biggest problem is really the allocation between the different parts of the portfolio. And then when it comes to picking stocks, like you said, you have to understand the industries. So you'll probably notice that I don't invest in sectors such as biotech or healthcare or such sectors that for me aren't my area of expertise. I want to focus on stocks which I understand, which are easy to understand, because then they are also easy to manage, easy to run, and they are really predictable what the company is going to do. So those are the stocks I focus on. And of course, you have some unpredictability, like with Nvidia, right? Practically, I would say that everybody knew what's going to happen in this report, but nobody knew what the guidance was going to be with Blackwell and everything. But that's when you go into a little bit more unpredictable business, a little bit more risky business. But again, it's balanced by the other side of the portfolio. And when it comes to picking stocks, I, of course, use multiple sources. I use Guru Focus and Seeking Alpha a lot. Those are like two paid sources that have been really, really helpful for me.
We have now the FinChat also, actually. We have access to the FinChat thanks to
Yes.
eToro since, I think since this week, since a couple of days. I just started looking into it, but I haven't properly analyzed any stock yet through FinChat. But I think that's also an interesting addition, right?
It is. I just noticed recently that we got something like that and I signed up, and the platform looks really good. But for me, it's kind of hard to navigate because it's really new, right? I'm used to seeking, I'm used to guru focus, so it's what I stick with for now. But it's really interesting that we have the FinChat platform, and it seems to have a lot of data and be really useful. But I think it's going to take time to learn how to work with it.
Yeah. So when you pick the stocks, so you make sure to pick stocks from sectors that you understand and or that you even have an expertise on as a former computer science student and now a corporate finance student. So you want to understand the sector, but you also need to understand the businesses, right? To have sufficient knowledge of what's going on in the business. And then once those criteria are satisfied and you have your short list of stocks, you screen them through Grow Focus and Seeking Alpha for their financials, for the evaluation, right? Or what's your exact area of focus when you're screening the stock? Does the stock have to be cheap relative to competitors, or does it have to be cheap relative to historic valuation? Or do you care more about the estimates, how it's going to perform in the next couple of years? I think I understood that you have a focus on estimates because it's something we didn't discuss yet NVIDIA and the earnings from yesterday, but it's something you brought up also, is that the guidance is something really important, right? To know how the stock is going to perform.
Of course. Well, I think that this differs from company to company. Like you said, I focus on sectors which I understand, which is the first filter, right? Then, based on macroeconomic conditions and what I expect the economy to do, I pick those sectors which I expect to perform well, or which I see as undervalued given the current economic conditions. And then usually I don't necessarily screen all the stocks. I focus on the leaders. So I look at the biggest companies in the sector, look how their business does, look how they compare to the other big companies. That's another thing, that I focus on companies with at least 1 billion in sales, usually with maybe some exceptions. Because I did invest in smaller companies in the past, and really a smaller company, when it gets into trouble, when your sales go from 1 billion to 800 million, it's not as bad as if they go from 100 million to say 20 million, or they go negative, right? Which is what I experienced with companies that encountered some kind of problems. So I focus on the big companies in the sector. Then I look at their business. That's the first thing I look at. Is this a quality business? Is this a business that I want to own? Because the valuation is pretty much secondary in analysis. Because if it's not a high quality company, then it doesn't really matter how cheap it is, because I usually won't buy it. If I'm sure that this is a high quality company that I want to own, then I look at the relative valuation. But here it depends. Either if I look at the relative valuation based on the history of the company, if the history has been a reliable metric to go against, or I look at the competitive valuation based on the biggest peers, right? And then I look, why is this company undervalued? Why is it overvalued compared to the industry? Or with stocks like NVIDIA, I look at the guidance, I look at the expectations of sales, at the expectations of the industry as a whole, because I would say that the higher the growth of the company, or the more it's dynamic, it's moving, the less investors look at maybe historical performance, and the more they look at the expectations. Right. When it comes to realty income, if I see that the company has grown AFFO by 4, 5, 6% in this quarter, then they expect something like that for the next one. I really want to see just the reassurance that they did earn this and the business is still doing well. And it's a really predictable business. So unless I see something really bad, I'm not concerned about it. But when it comes to NVIDIA, the valuation is, I would say, above fundamentals right now, which is not necessarily bad because the company is growing really fast, and it's hard to value such a company if practically nobody on Wall Street knew for 2 years what it's going to do. You know, it created a whole new industry. And so there, the expectations have a lot more weight than the actual results of the company, because that's usually priced in given the high multiples. So that's how I look at stocks.
So
I'm not sure if that answered your question fully.
I want to go back to the
Absolutely.
to the point you said that a company that has $1 billion in sales and then it goes to 800 million, they're going to take a hit. So do you prefer larger companies more than certain amount of market cap because they're not as easy targets to the hedge funds, so they're not as volatile as others? Because what you're going to do, you're going to short Microsoft or Apple if they have a bad quarter? No, it's going to go down, yeah, but it's not going to, because they're such a large companies, they're not going to be targets of institutions. So are you trying to avoid that risk by investing into larger companies?
I do invest in larger companies to avoid the risk, but not that specific risk.
Okay.
It's more of the business risk, the risk that when the tide goes out, when economic conditions worsen for the industry, the smallest players will usually take the biggest hit, right? Because if you're the market leader in your industry, you have a good balance sheet, you have good cash flows, you have a good competitive position. But if you're trying to disrupt the industry and grow, maybe you have more leverage, maybe you have less cash reserves, etc., then I see that as more of a risk to the company when things go bad. So that's why I focus on, I would not necessarily say large companies, but the larger ones. Like I said, usually at least $1 billion in sales. But when it comes to, like you said, short selling or hedge funds or etc., I would actually see that as an opportunity to buy the company. If there was some kind of, manipulation, not that the company is doing bad and somebody shorting it, but like you said, when the, non-fundamental factors play a bigger role, that's when the opportunities arise, because that's when the price can diverge from the intrinsic value of the company.
Oh yeah, that's
Yeah.
the obvious move to do, to buy it. I'm just saying, because some people are feeling uncomfortable holding a small company that had a misstep for whatever reason, and the next day after the earnings is down 10% because it's just an easy target. Because that's what the market does. They find easy targets and then they target them. But the larger companies, the mega cap, they're too big for anybody to target. I mean, if you're a hedge fund manager and get on CNBC and say I'm shorting Microsoft, nobody cares because you're not able to do anything. But a smaller company usually targets. That's why most people avoid them. That's why I was asking if you prefer larger or small.
That's
I
also
understand, and
that's also true with the short selling reports, right? When you have reports like, for example, Muddy Waters coming out, usually it's smaller cap companies, or companies that are less analyzed as well. The big companies tend to have maybe millions of people analyzing them, right? So it's really difficult to for a big company, for a very large market cap stock to be committing any kind of fraud or hiding anything, because you really have millions of analysts following them every day, day to day, and going into the premises of the office, right? So there's also that risk mitigant. We say big tech tends to be risky, but the really big tech is actually fairly low risk. Sure, there's a lot of movement, right? It's not uncommon for a stock to lose 5% or 10% or more of its, or we saw recently with Nvidia, I think it burned 40% of its market cap in 1 month in July, right? Went from $140 to $100 per share. This is not uncommon, but overall, big tech tends to be kind of a safe haven recently, in the recent 10-15 years. When it comes to your returns. Of course, there are bad times as well, but dividends actually, and I wanted to return to that part. Dividend stocks in my opinion, are also high risk. Let me explain my point. Dividend payers tend to have that expectation of having to pay dividends and having to pay more and more dividends every year. And that's the expectation of the dividend shareholders. And if one day there is some kind of downturn, the debt becomes a little bit more expensive than it was, or maybe there is some kind of headwinds, the company might be trapped, might not be able to invest to reinvent itself, and might be trapped to continue doing those dividend payments, those very large ones sometimes, like AT&T. AT&T feels somewhat like an obsolete company that is not really innovating anything and that is handing all its free cash flow to the dividend investors. The reason being that a dividend stock, when it decides to slash its dividend payments, usually there is a huge sell-off and it loses a big portion of its market cap, and that could be the end of the dividend stock. So it's also something that we need to mention, that dividend stocks also have a big level of risks because those companies are trapped in their dividend payments, in the expectations of rising dividends, and at the same time they cannot have enough cash to reinvent themselves, and at the same time they cannot cut dividends. Do you see it the same way?
Yes, definitely. I do think that this is a risk because the dividend gets priced into the stock. The dividend expectations get priced into the stock. So when you have a dividend cut, or if you only have slowing in the growth of the dividend, right, that negatively affects sentiment, that negatively affects the valuation, of course. I think that how I try to mitigate that is there's three things you look at. Of course, you look at the dividend history, you look at the growth, and you look at how much the company is actually paying.
Yeah, the payout
You
rate.
also look at the interest coverage, how it can service its debt, and etc. And so the companies I invest in, of course, you could invest in AT&T when it had what 9% dividend yield, but they had tens, if not hundreds of billions in debt. I don't remember exactly, but they had a lot of debt. And that was a risk that when sales declined and the company stopped doing as well, they had less free cash flow. They could not service the debt and the dividends, so the dividends became a real burden for the company. That's what I try to avoid. Usually the companies which pay dividends in my portfolio have a long history of dividends, which of course isn't enough, but they also grow them at a steady rate. So they grow them in the sense that they don't just want to grow the dividends, they grow the business, and that's why the dividend is growing. Right. And the next thing is that they pay out a reasonable sum in the dividends. So even if the company does poorly for a quarter or say a year, it can still pay out its dividends without having a lot of trouble. And there we go back to having large cap companies or bigger companies. Usually they have better balance sheets. They borrow at lower interest rates, right? And so the risk of the debt becoming a big problem for the dividend, or the other way around, is lower.
Do you
Right?
have
So that's
any,
definitely a risk I look at.
do you have any dividend aristocrats in your portfolio? I don't remember. I took a look at your portfolio, but I don't remember if you have any.
I do. Realty Income is a dividend aristocrat. That's a company in the portfolio. I'm actually not sure if any other of the companies are dividend aristocrats, but they usually pay dividends for more than 10 years sustainably. If, of course, the longer the better, right? Energy Transfer has been paying a big dividend. Enbridge has been paying a big dividend. Agree Realty as well.
I think Next Era is also another. You have Realty Income and also Next Era. I think that's another dividend
They
aristocrat.
definitely have over 15. I know that, but I'm not sure if they are a dividend aristocrat. Probably if you said so, they are. So yes, that's also something I look at. Is the stock a dividend aristocrat? Is it maybe a dividend king? You know, how long is the history? Because when I say a good dividend history, of course, I don't mean 4 or 5 years or 10 years. I mean, ideally, you know, the business has been paying dividends for more than 10, more than 15 years. Of course, that's not achievable with some companies such as Agree Realty, I think, because they have not been public for long enough. But they have been paying dividends ever since they went public, and they have been growing those dividends. So to me, that's as good as having a dividend aristocrat.
And then in the other spectrum, when you go to tech, to big tech, they start paying dividends. Google start paying dividend recently, and Facebook, and Meta, and Microsoft and Apple. So they pay dividend, but they just pay dividend because they have too much money and they don't know what to do with. They can't buy any companies because the regulators come after them. For a tiny little company, they can't buy anything. So instead of holding the cash, they just distribute them to the shareholders. So again, you have the two extremes. You have to go through the dividend to check if the dividend is viable and if the payout ratio is decent and is not too much. So in the long term, it's going to hold, because that's the risk you have with dividends. And then the other spectrum with big tech, the dividend is almost guaranteed. I mean, the war has to go completely south for Microsoft not to pay dividend. I believe it's the only company with investment grade bonds in the stock market. So if Microsoft doesn't pay the dividend, then we are screwed.
But Dimitri, let me disagree a little bit with what you're saying, because I mean per se I agree, but I don't think it's relevant at all, even the word dividend, when you're mentioning those stocks, because it's not even 0.1, not even sometimes 0.001% dividend yield for those stocks. So it feels like it's more a symbolic way for them to pay those to announce the payment of those dividends.
Yes. Symbolic,
to, you know, right? It's more symbolic. And I think when Alphabet announced it, the parent company of Google announced earlier this year, they announced the dividend payment, the stock went soaring actually. And the same happened with Microsoft. So it feels like those symbolic payments are more there, you know, to make the stock rise. Because what would you rather have? Something that pays a 5% dividend yield, a little bit higher risk because it's a high dividend payments, or a guaranteed 0.01% dividend yield that's just going to give you headaches when it comes to your tax to your tax returns at the end of the year? Does it make sense? My question is, does it even make sense to consider those big tech stocks when we're talking about dividends?
If you are a large investor, and let me answer this first before I forget, if you are a large investor and you hold hundreds of thousands or millions of dollars in one of those stocks, then the dividend is going to show. But if you're holding 10 shares of, I don't want to say that 10 shares are like little, but if you hold 5 shares of any given company that pays less than 1% dividend, then basically the dividend doesn't make any difference to you. So but if you are Mark Zuckerberg and you announce a dividend and you own 200 billion worth of Meta stock, that dividend payment is quite large sum of money. So you have to look at that way as well.
So what you're saying is the dividend payments of those very large market cap stocks, those symbolic ones, are more an incentive for the top shareholders?
Absolutely. Absolutely.
I definitely agree with Dimitri.
Yeah, absolutely. It's completely symbolic. They have the money, they don't know what to do with them. They try to buy a little. Do you remember what happened with ARM? NVIDIA wanted to buy ARM, the company that went public a couple of months ago, and everybody, they blocked them in so many different ways. So you have the cash, you have the money, you want to spend it, but you can't spend it. So what do? You give it to your kids. That's basically what it is. Try to make a comparison like as raw as this, but you have the money and you can't spend it. Okay. You're getting more and more powerful, so you have to give
Yeah.
them away somehow. And
Right.
then you get that part of people, and you know these people exist, that they're gonna buy Meta and Google because they pay a dividend. But anybody that has a brain that doesn't buy those companies because of the dividend. The dividend is just something extra. That's my opinion.
Yeah. No, it makes absolute sense, actually, Dimitri. As we're approaching the end of, the discussion, I wanted to ask an open question, I'm not sure if, Dimitri, you have another point that you still wanted to discuss.
No,
No, it's, an open point. Jakub, what do you basically, why are you in the markets? What do you expect to achieve in your lifetime? Do you plan to bring your portfolio to your grave? I know you're very young, so that sounds like, it's going to be in a very, very long time. Or do you plan to, I don't know, invest maybe a decade or two and then retire? Or what is your future expectations? Are you in it for the very long term? Tell us a little.
Okay, that's a great question, actually. I'm going to split it into a few parts. The first, why I am in the markets. I believe that investing in the public markets is the most fair way to do business, because nobody cares where I'm from, nobody cares who I am, nobody cares about, the usual politics you get in business, right? The interpersonal relationships and etc. That's not a factor. Here, the deciding factor is, can I make money? And I can. And that is what motivates me in the market, that I don't have to start a company here in Slovakia or the Czech Republic and struggle to make it big, to expand it, etc. I can buy a part of Google and own the best company in the world. I can buy a part of Microsoft. I can buy a part of Nvidia. And if I study to understand these businesses and to understand investments, I think I'll have a much deeper knowledge of the business world, which is, of course, beneficial if I want to do some kind of business later. Ideally, over the long term, when it comes to me, I would definitely like to stay in the business of portfolio management, of asset management, either on eToro as a popular investor, which has been my goal for the past 2 years, and practically my dream, to be a successful investor, to help people make money, or some other kind of asset management, wealth management, that sort of stuff. When it comes to the portfolio, definitely I'm investing for the long term. I want to, that's why it's called the dividend fund, because my vision is that one day the portfolio will be big enough and successful enough that I can just collect my passive income from the dividends and live basically off of that income, right? To get income that can support me and probably, of course, my family in life. So that's where I want to get the portfolio. Of course, I'm going to need to appreciate it a lot more to get there, depending, of course, on how much I want to spend. But yes, this is definitely something that, like I said, I'm passionate about. I want to be really serious about it. I want to become an expert in it. I want to know everything there is to know, and I want this to be a big part of my life. Either investing for myself or for other people as well.
I think there's only one word I can answer. It's amen. Amen to that, because this is real. It resonates in me when all you're saying, and I think when you have a long-term view on eToro or anywhere else where you hold an investment portfolio, and if you have a long-term view, you're going to be successful if you have that long-term view when picking your assets and building your portfolio. You might not always outperform the index, and that's fine. That's absolutely normal. There will be years, where you'll underperform, years where you outperform. For now, you've outperformed every year of the 3 years that you were on eToro. So let's hope, that continues as long as possible. So thanks a lot really for joining our conversation today. I don't know if Dimitri, you usually have some kind of quote or some kind of image
No, I
you
wanted
like to share.
you asked Jacob that question, and I want to ask you that question because usually I'm the one and the guest that will do the talking, and you ask the question. So let me ask you that question. The
To
question,
me,
yes, yes.
look, my baby is 6 weeks old, right? My newborn. It's my first one. And my vision before having my newborn, my vision was, having that portfolio that I'll take care until my retirement, and then maybe transfer to, convert completely to bonds probably when I retire. But now that I have this newborn, my horizon is pushed by an additional generation. So I'm probably just going to take that portfolio all the way to the will, and then hopefully my, who comes after me will inherit that portfolio and continue taking care of it. And I'll make sure if my son and my kids, if I have more kids after, have that interest in investing, I'll make sure that they also have that long-term vision. And that circles us back to actually the beginning of the episode where Jakub said that his source of inspiration was actually his father, and where he learned a lot from his father. And I am sure that Jakub, if he has kids later, will transmit the same knowledge and the same
I have a
inspiration
question
to
for
the
that.
next generation.
I want to ask him a question about his father, because at the last summit I saw you with, we haven't met, but I noticed you with your father, and I wanted to ask you, did he try to push you into it, or were you curious about it and you had the interest?
Well, I would say both, because at first, I was pretty young. I was a teenager when he started, and he was really excited about it, really interested in it, and he always used to tell me that you have to do this. This is the business you're going to be successful in, because he knows me, he knows how I think, right? And he knows business. He hasn't been an investor or worked as an investor, but he's been in business for his whole life. And so at first he wanted to, guide me on the right path. And then I think in time it started to interest me so much that I basically structured my whole life, everything I do, around investing and around becoming a successful investor. So I think it's a mix of both. I would say he really inspired me.
Yeah, the reason I'm asking, because sometimes, and I see that from people I know, parents, they're pushing their kids towards something, and the kids, they just for the sake of saying no to their parents, they're saying no. So I was just curious if he was his excitement about investing that got you into it, and then maybe later on your own excitement got the rest of it. And very soon you're gonna get on the next level, and that's awesome. That's why I was curious to that, because like I said, I saw you with your father last summit, and I had that question. I was just curious.
Yeah, exactly. Like you practically said that. It was something that he came upon, and he knew that this would be the way for me, and I would say that he showed me the way. It's not that he forced me into it or anything like that, because that definitely wouldn't work.
Yes, yes.
It's just that um yeah, he showed me the way. He showed me something that he thought I would be interested in, and it turned out that I'm really interested in it, and it really is a passion for me
Mhm.
now.
Mhm.
And maybe to circle back a bit to what Akim said, to maybe say quote to end the episode. This is actually a favorite quote of my father's. is that success is not a coincidence. It's a function of time and effort.
Hmm.
And I think that really sums up what you said, Akim, about being successful in investing.
Absolutely. Beautiful equation. All right, I think there's no better way to wrap up the conversation we had today with you, Jakub. Thank you for being our guest. So your username is @thedividend_fund on eToro, and we will put the link in the description so you guys can check out Jakub's portfolio. And it's a really interesting one. Honestly speaking, if I was not a popular investor, I would seriously consider copying you, because it's really interesting, that marriage between AI, like really innovative tech, and dividends, stable income kind of investments. So thanks a lot for joining today, and
Thank you too.
and guys, see you next time.